Welcome, everyone, to our webinar today on why and how to scope R&D tax credit benefits provided by Cherry Bekaert today. We're going to talk to you a bit today about a lot of topics of interest, but before we get to that, we'll get to a summary of CPE. So to receive CPE credit, you're going to have to answer at least 3 polling questions and attend for 50 minutes. CPE certificates are going to be issued via email within 10 days. And after 10 days, if it hasn't been received, please email CBH Learning at cbh.com. A recorded version of the webinar will be available in about 1 week. It will be sent via email and posted to our website. If you have any questions during the webinar, please type them into the Q&A window, and a short survey will be posted at the conclusion of the webinar. So today's topic is why and how to scope R&D tax credit benefits. We're very excited to provide this to you today. And additionally, as a topic here, we're going to discuss the benefits of using a full service accounting firm for R&D as opposed to a boutique. So we're going to go through some of the basics around R&D, and then we're also going to have a client panel toward the end. With respect to my team, who's on here with me, I'm Marty Kehrman. I'm a principal at Cherry Bekaert Advisory, principal in charge of our tax credits incentives advisory practice. My 2 partners, Dan Mennel and Ron Wainwright, will be speaking as well. And directors on our teams, Vivian Kors and Carolyn Smith-Driscoll, are going to be presenting as well. And then later we'll have a client panel toward the end. With respect to overall what we do here at Cherry Bekaert in the Tax Credits Incentives Advisory Group, we're focused on saving costs, increasing cash flow, without a doubt, improving a company's tax position. But we're also focused on activities that a company may engage in, anything from R&D to hiring, to investments in alternative energy, to expanding into new locations, and also for building buildings as well. There's a lot of different incentives, both federal and state, that go along with different activities. So we tend to focus it, as the R&D credit does, on an activity basis and try to match up incentives that way. And that's part of the benefit we're talking about as well, with a holistic view of our clients from an overall tax perspective and what incentives may be available. Our agenda today is going to be focused on, we try to make it fun. What we try to do is, a lot of companies don't necessarily understand what it takes to scope an R&D tax credit benefit, and it's not always as hard as you think it might be with the right team and with pulling some of the correct data. But we're going to go through an education session just at the beginning with respect to what the R&D credit is, some of the basics that make up whether or not you qualify for it, talk about what the benefits are of looking at R&D now as opposed to sometime in the future, because even companies without a current tax liability may benefit from it. We're then going to go through what our process is with respect to how we scope, what info we ask for, what we're focused on from an IRS perspective in terms of what documentation they'd like to see, the different methods of calculation, and some of our online survey tools that we've developed as well. After that, we're going to get into some what we'll call hot topics, but we'll call it topics of interest right now around the R&D credit, a few industry examples on R&D, and then our client panel, which we're excited to present about some of the experiences of working with an accounting firm as opposed to boutiques in the past. All right, with that said, I'm going to turn it over to my esteemed colleague, director in our group, Vivian Kors. Vivian, take it away.
Thank you, Marty. So the R&D tax credit has been around since 1981 as part of the Economic Recovery Tax Act. Since then, it's been extended, expired multiple times, but as of 2015, as part of the PATH Act, the R&D tax credit is now a permanent benefit. But even then, it is still often overlooked and misunderstood by a lot of taxpayers. In particular, people always think, oh, I have to be wearing a white lab coat, curing cancer, that's R&D. That's not the case at all. If you truly look into what your company does, once we understand what you do, there has to be some sort of evaluation as to the activities to determine whether or not you actually qualify for the R&D tax credit. And it's much broader than what generally people think of as IR&D. As part of the recent Inflation Reductions Act, there are also changes that make the R&D tax credit more beneficial to startup companies, and we'll touch on that a little bit later. But as of to date, there's only 35% estimated of taxpayers who are eligible to claim the credit that actually take advantage of the credit. So our goal here is to educate you as to what qualifies for the R&D tax credit, and then also work with you to evaluate what would make the most sense for your company. So we can switch to the next slide, thank you. So in addition to the federal benefit, there's actually benefit for states in more than 40 plus states. So a lot of the state benefits are either refundable or maybe it's application based. So it's really different across all states, but you also have to think about, in addition to the federal benefit, what you could get depending on which states the physical work is located in. The federal research credit is a dollar for dollar reduction in your tax liability and can be carried forward for 20 years. To the extent that you qualify as a small business, you could also use the R&D tax credit to offset your federal withholding taxes. So with that said, there are a few ways that you actually calculate your R&D credit, and it's important that you evaluate both ways so that you can maximize your benefit. We have a lot of clients who previously have always claimed the traditional way. When we stepped in and we evaluated for them, we realized, hey, you've actually been missing $1 million of your R&D tax credit because you've been only looking at your traditional way. So it's important that as part of your scoping process that you look at both ways in which that you calculate your R&D tax credit. Another thing that you also have to think about is for portfolio type private equity companies where you have many different distinct operating companies. It's depending on the control group rules, we may be able to scope the R&D tax credit benefit separately for each of those companies. So you're not needing to get data from all of your companies when some of those companies don't have any R&D activities or minimal R&D activities. And the last point is it's never too late to look at your R&D benefits. We can look at your current and previous open tax years of your potential benefit. To the extent that you're a C Corp and you've been in losses, there's also potential for you to go back all the way to the beginning and claim the credit carry forward in your current year. So those are all different venues that you could be looking at. Now to the fun part, what actually qualifies for the R&D tax credit? You're going to hear us refer back to this a lot, and this is what we call a 4-part test. So it's an activities-based test, and it looks at whether or not the activities associated with your projects meet all 4 parts of this test. So the first test is called primitive purpose test. What this is saying is at the outset of the project, your team has to be trying to improve or develop new functionality, performance, reliability, and or quality. So functionality could be previously the system couldn't do X, Y, and Z. Now it is automated. Performance could be previously our throughput was at X. Now it's improved to 2X. Reliability could be, there's less crashes, there's more data availability, and then quality, trying to improve the overall quality of the product so that it can provide better services. It can be longer shelf life, all of those things that basically lend itself to a primitive purpose. The second test, which I would say is the easiest test out of all 4 parts, would be technological in nature, meaning your activities must rely upon a hard science as opposed to soft sciences such as psychology, aesthetics, that sort of thing. But hard sciences, computer science, physical science, chemistry, engineering, different types of engineering, as long as your activities rely upon those hard sciences, then that meets that test. And then the last 2 tests, I would say, actually go hand in hand with each other. The third test, elimination of uncertainty. What this is saying is at the outset of the project, your team has to be technically uncertain as to the capability, method, and or design of the product. So capability is, oh, this is so novel. We don't know if we could get the system to do X, Y, and Z. Method is, we knew we could eventually get there, but we weren't sure what the best way it was to go about development to either minimize downstream system impact or minimize your development timeline and spend. And then design. We weren't sure what the optimal design of the product was in order for it to be most performant. Then through a process of experimentation, which is the last test, you guys evaluated 1 or more alternatives to try to resolve your technical uncertainty. You didn't have to have resolved your technical uncertainty, but you have to have tried. So this is where we want to talk about what were the different things that you tried, what were the different things that you could have gone that you evaluated and why it didn't work. It has to be a systematic trial and error and not a random test. Another thing that I want to point out is we have to differentiate technical uncertainty from business uncertainty. So some examples of business uncertainties, oh, we couldn't get the right resources, or we couldn't get the right, C# coders. So those are just things that you should think about and often refer to as the 4-part test. To the extent you qualify, you meet these 4 parts, you could potentially qualify for the credit. And I'll turn it over to Carolyn to talk about non-qualifying activities.
Thank you, Vivian. All right, non-qualified activities. And I will say that this is, it's codified. These are not qualified, but because it's an activity-based credit, we don't want to take this as gospel. We want to unpack it and look into your company's activity. So the first non-qualified activity is research after commercial production. You're already producing it. You're not developing or improving anything new. Now, what we want to look at here is perhaps you've been building something for 10 years and you're changing a formula, or you are increasing throughput. You're having some quality issues. That would likely be qualified based on Vivian's definition. So even if something is already in production, don't walk away from it as potentially qualified activity. You want to dig deeper. So funded research, this one is very, very complicated. It looks simple here as it's just one bar on a screen. Research that is paid for by a government grant or by a customer is not eligible for the R&D tax credit. It's actually who's ever paying credit or the government. There are a number of ways to evaluate whether research is funded. Contract type, contract term, are they firm fixed price? Is it time and material? It's important. We do spend a lot of time on our TCIA team looking into contract evaluation to make sure that there is no funded research. The next one is foreign research. This is pretty straightforward. If it is not occurring on U.S. soil, including Puerto Rico and the other U.S. possessions, it is not eligible for the R&D tax credit. And the next one is routine testing and quality control. So if you're manufacturing something, just routine QC. You pull 3 or 4 out of 100 to evaluate. Again, it's similar to research after commercial production. We want to make sure that we're digging into the activity, because if it truly is routine and you've been creating something for the past 10 years, that would not be qualified. However, if you are identifying any issues, quality issues, throughput issues, and you engage in the 4-part test that Vivian spoke about, then potentially the activity could be qualified. All right, so some more non-qualified activities. Adaptation and reverse engineering. You can't buy something and take it apart and create the same recipe. So that would absolutely not be qualified. If you are adapting something to a specific customer, that's a lot more nuanced. If someone's buying a car and they want it blue versus pink, that would absolutely not be qualified. However, if you are responding to certain customer requirements and you incorporate those into your product, it's not just specifically for that customer, there may be an opportunity to categorize the activity as qualified. So non-scientific research, market research, efficiency surveys, advertising studies. Vivian mentioned business uncertainty, if market research is related to that. Six Sigma is something that is often misunderstood. There can be components that are non-scientific and not qualified. There also can be components that are qualified and meet the 4-part test. So aesthetics is also considered a non-qualified activity. So style, taste, cosmetics, seasonal changes. Again, that's something that we want to unpack. Terry Bekaert and the team and I, we perform a number of studies for food manufacturers. So obviously taste is an important part of that, but we focus on shelf life, recipes, different protein, reduced sodium, things like that. It's much more than just taste, even though taste is a component of the research and development process. All right. So internal use software, that's a fun one. Vivian mentioned the 4-part test, so the activity needs to meet those 4 prongs. The IRS does not like internal use software. And in fact, in 2016, final regulations were issued. And internal use software is software developed primarily for a taxpayer's internal use. Think, billing systems, CRM systems, things like that. So because they're not banned, they have added 3 additional tests. So it, in essence, is a 7-part test for internal use software to qualify. So the first is significant economic risk. And this one can be a little bit fuzzy because what would be significant economic risk to one company may look very different for another company. But they want to make sure that you are investing quite a bit in the project. The next prong is the Innovativeness Test. It goes to, it's got to be intended to provide some type of improvement, automating a previously manual process, reduction in costs, or some other type of measurable improvement. It's got to be new and different, and there has to be a reason you are investing significant amounts of money to create this software. And then the 7th prong is commercial unavailability, and that just means you can't go to the store and buy it, or you can't download it. It's not commercial off-the-shelf software. So, all right. So this is an important one. So claiming R&D credits without a tax liability. Vivian was talking about the dollar-for-dollar offset to taxable income. There are a number of opportunities for companies that may not have taxable income to use the R&D tax credit. She also mentioned the payroll tax offset for eligible companies, which was increased. So an eligible company, let me tell you what that is a startup company that has gross receipts for less than 5 years at $1, unfortunately, in interest income in year 6 would disqualify the company from utilizing up to $250,000 of R&D tax credits to offset the 6.2% employer payroll. And additionally, the company needs to have fewer than $5 million in gross receipts in the current year that it's being claimed. The Inflation Reduction Act that just came out did increase the opportunity for companies from $250,000 to $500,000. The next $250,000 will be available to offset Medicare tax, the 1.2%, I believe. So the payroll tax offset, very, very valuable for startup companies that are eligible because it can reduce operating costs. And even if you have characterized your R&D tax credit as a payroll offset, even if you are out of the eligibility period, once you characterize your credit that way, you're able to continue to utilize it to offset your payroll taxes. So credits flow through to partners and partnerships and shareholders of S Corps on a pro rata share. So even if the company is not in a taxable position, the credits will flow through to the shareholders and partners. Additionally, I sit in California, so the California credit for S Corps, it's really a bonus. 1/3 of the California credit stays at the S Corp level to offset California's 1.5% S Corp tax, and 100% flows through to the shareholders. Again, pro rata share. So it's 133% of a credit. So additionally, many state R&D tax credits are refundable. California is not refundable, but even companies that are not taxable in their state, many of these states have application processes. If they comply with the application process, really, monitoring timing, they can receive a check back. You don't have to have tax liability to monetize the credit. And it's also a double dip, state credit. Not only can you claim the federal credit, but you can also claim the state credit for activities that occur in your state. So for companies that are in a loss position. You may be thinking, boy, I'm not taxable for the next, 2 or 3 years. Why should I engage Cherry Bekaert to do an R&D tax credit study? There's a couple of reasons. First of all, even if you're not able to currently use the tax credit and you're not able to avail yourself of the payroll tax offset, the credits carry forward for 20 years. So they become a deferred tax asset that you can aggregate. And once you are taxable, you're able to utilize those to offset your taxable income. Importantly, there's a few elections that need to be made on a timely filed return. That does include a properly extended return. So we're coming up on 10/15 here. So a couple of different protective elections. One is for the calculation method. There's two methods, as Vivian talked about, the alternative simplified credit and the traditional credit. If you do not elect, even if you're not putting a number on a form, if you do not elect ASC and you would like to alternative simplified credit, and you would like to utilize that if you go back a few years to amend returns, you may have missed that opportunity. Additionally, we call this a protective election, protective 280C election. And what this does is it really just streamlines the process when you go back to amend, because the credit has been rate benefited and you don't have to adjust your NOL, things like that. They do need to be made, both of those need to be made on timely filed returns. So again, it's called a protective election. Something else, can you go back? Sorry, thank you. So we're talking about companies that are in loss positions and things that they should do. I do want to let you know that there's a IRS Chief Counsel memorandum that came out, and it's effective as of January of this year for companies that are amending their tax returns to claim an R&D tax credit. There is a new gating process. So additional information is now required. So it may make sense to maybe not do a full-blown study, but to look at your current year activity so you can make timely filed elections and timely filed tax returns. All right, I want to hand it over to Marty for our first polling question.
Absolutely. Question 1, how does your company currently analyze and support its R&D credit? A, we have never applied for R&D tax credits. B, it's internally prepared. C, we use a third-party provider. D, we use a third-party non-CPA firm. Or E, not sure. And we'll see how those come in a moment. Carolyn, thank you also previously for that. And just to reiterate one point, most importantly, on why now, around that payroll tax offset, as Carolyn said, you need to make that election on a timely filed return or else you lose that opportunity. So if anybody even thinks they have a small amount of R&D and they don't have a current tax liability, it's well worth just calculating what a credit would be and getting that on the return so that you can take it as a payroll tax offset so you can stop paying payroll tax for a period of time. All right, so there's the answers. We have never applied for R&D tax credits as the highest one. Love to see that, and I'll tell you that's exactly what we're going to go into now with respect to what our process is. You may see right now, you'll see it on the internet, you'll see it from a number of like advertising providers, that the R&D tax credit is something like punch in my wages, punch in my industry, and here's your credit. It's not that easy. It does require sometimes a human process. There are a lot of firms out there promoting some technology that can take the entire human component away. I think we have a good group of humans here, and I think there is a bit of a human aspect to it as well with respect to making sure it's company specific to you. And so from our perspective, with respect to our process, any of those 38% out there or anybody else who would like to talk to us about the potential for taking R&D, we can do it over a 30-minute discussion just about what your company does, how many employees you have, what the activities are in which you engage. We'll talk about your history around acquisitions, dispositions, and also what you have going on with respect to projects currently and in the future. We'll get into some of the data we'll collect, but it's not particularly onerous. We're going to get your W-2 data by person with a job title, department listings as well. We're going to get some of your general ledger information. And for those companies that have time tracking, that's a wonderful tool that we can utilize in our process. But again, we like to keep it easy for you. I don't generally want anybody to prepare ahead of time as we talk to them. I just want to talk through what the process is. And that's what we're really doing for you today, is getting you a sense of like what it is we're going to do, a 30-minute call. And then after we collect your data and talk to you, we may have to have like 1 or 2 calls back with you as we analyze the data and pull together at least a rough sketch summary model of what your credit we believe should be based on industry, department, job titles, time tracking. We'll do all of that in the background and come back to you with an estimate of the federal and state research credits. And then most importantly, and here's the difference, I think, in some ways, is we'll prepare a work plan and a fee estimate for your approval, but it's really going to be based on what level of documentation is necessary for you. And it's not a contingent fee. We're not even permitted to charge them for federal tax work. The reason for that is, well, there are reasons under Circular 230 for that, but from our perspective, these are your credits. These are not our credits. This is a service that we provide, and we think we can provide it well, but our goal is to provide a service, a holistic view into your company and maybe find additional opportunities. It's not to take a slice of your credit. It's really to get that credit for you and document that. I think 1 to 2 weeks, probably after we have the initial conversation, we can come back with a work plan and an estimate of what the benefits are. Why don't we move on? Okay. Okay, so with respect to what our process is, and I'm losing some stuff on the slides here. There we go. Thank you. All right. What we're going to do in a full study, what we'll call after we're done with the scoping phase, is we will have already accumulated your financial and your cost information, but we're going to integrate that as well if you have time tracking. We may have been able to do that during the scope. Contemporaneous documentation, and this is another reason that we talk about doing it now as opposed to later, is from both a technical perspective and associating certain individuals with certain initiatives. It's better to get the information fresh than at a later time. And so that's one reason to think about what's available now. It may be easier to do it now as opposed to in the future. Interviews with technical subject matter experts. Everyone worries that this may be overly time consuming for their people. It isn't. We have a lot of experience on with respect to talking to engineers, software engineers, manufacturing process engineers, just across the board. It really is a chance for your people to show off a bit in terms of what they've done that's cutting edge or different, or what makes your company unique. We generally find it's a collaborative experience, and it never takes more than 45 minutes to an hour with any one person. And we generally pare down the number of individuals we need to speak to based on what some of the larger initiatives are. We will ultimately, at the end, document everything, prepare what the projects are, what the costs are by project, and our overall methodology. And then internally, I think this adds a lot of value, is we have a mock IRS exam called our QC process before we ever provide a analysis of what the credits are back to a client. The intent is for us to kick the tires on it a bit and have an independent third party who wasn't on the team take a look at it and review it and think about what the IRS may be asking, just to make sure that we're covering all our bases, or just to get a different opinion on it. What we have here, total time 1 to 3 months, that's probably fairly accurate. And it's not always based on like how long it takes us to do it, and that's not all the time that goes into it. It really is a matter of working with you and your company and when you're available in order to get that done. We're always focused on what the ultimate filing deadline is, so we want to make sure we hit that. Last part here is our deliverables at the end are clearly intended to address what the IRS wants to know should they ask. Again, this appears on your tax return. There's no documentation that needs to be submitted with it, but to the extent there were questions, we will have already documented this. And this, by the way, list here, and on the next slide as well, is a summary of what I have seen over the last 10 to 15 years through information document requests issued by the IRS on all RD studies nationwide. And so it sometimes comes down to like, who are the individual who filled out the survey? What documentation do you have? Provide your credit calculation. All of this is included in our deliverable. It addresses all of these points, but there are certain little hot button issues that the IRS hates to see, and we will never have anything like that in our reports. Things like, did you use box 1 W-2 wages, or did you just use higher level costs? It's detailed. We do the detailed work, but if we have the right data, it's no more time consuming than if anyone did a high level estimate. We're very adept at it, and the more data, the better from our perspective. Okay. All right, so this here is our information request. And from a costing perspective, we are always focused on 3 costs primarily: wages paid to individuals who are engaged in the R&D process, your amount you pay to third-party contractors who are doing work on your behalf, that can be included. That's generally from a general ledger pool. And then also supply costs. To the extent you have prototype or other testing supplies that are utilized in the R&D process, those are included as well. So last for the tax returns, the org chart. If you had prior studies, we're more than always willing to look at those and get a sense of how they were done to make sure we're consistently analyzing what you did in the past compared to currently. And oftentimes when we work with companies that work with someone else, we will find more in the past that might have been left behind. R&D lifecycle document, all this really means is, are there any internal memos or PowerPoint presentations about what, it's 2 things. What are some of the big projects that year, but also what is R&D to you? What is your stage gate process? How do things get approved? Who's working on what in which stage? And so we are always looking to use your data and tell the story according to how your company operates. And so again, this is the most data you'll ever have to give us. The more we get up front, the better our scoping can be. But from the perspective of those who might be participating in the process and talking to us about some of the technical aspects of what you do from an R&D process, this is just an easy data pool that we'll work with. The more data, the better. It gives us a mapping of the company, and then we'll be able to go forward and have intelligent conversations with you. Question 2. Okay. Does your company allocate each employee's time to both an activity and a business component? And real quick, business component really in this case means it's a term of art, but it really means like the project in some ways. Are you showing cost by project and by person, et cetera? So 1, we do not take R&D tax credits, so we don't perform R&D. 2, no, but perhaps we need to consider it. Yes, we use a time survey that addresses this. Next, our time tracking management tool does this, and not sure. And I'm going to answer so I get CPA credit. And for everyone who's attending, thank you so much for taking the time today to listen. I and the team are more than willing to take the time after this to answer any additional credit questions you may have. Performance scoping, we're at your disposal, really. So you have our email addresses in the materials here. Okay, so top answer, no, but perhaps we need to consider it. I would say you do, and we can help you. Yes, we have a time survey. Is at 23%. Our time tracking management tool does this. So interesting. That's great. And, you know, that 9%, we're happy to talk to you about it. With that said, I'm going to kick it over to my partner, Dan Mennel, to talk about some more specifics around the R&D credit.
Thank you, Marty. Appreciate it. I mean, again, just to reiterate, Marty's point, our overarching objective is to have an IRS-ready deliverable, and at the same point, very cognizant that we want to be as least intrusive as possible to your team. And that's really the fine line that we try to walk in the way we approach the work that we do. So as Vivian and Carolyn have talked about before, there are multiple ways to calculate the credit. First of all, overarching, the credit is incremental. So you have to be spending more money over a base amount. The 2 calculation methods often referred to are RRC, regular research credit, and the ASC. Generally, the RRC can be higher at 20% versus the 14% of ASC. If you'll go to the next slide. This is a side-by-side calculation of both. To the left, you can see the traditional, or we call the regular research credit. Same fact pattern applied to both. but because of the higher credit amount of 20% versus 14% on the simplified, you can see that the regular research credit to the left generates a higher credit. One thing I'll point out, and Marty, we've consistently said this throughout, is you have to annualize this annually. Things like an M&A activity of an acquisition or disposition, you have to carve out your base. And so what might have been the more advantageous credit in one year could change depending on the impact, the number of years that acquired entity had R&D and the extent to which they had R&D could impact this calculation.
Yeah, and even additionally, it is called the credit for increasing research activities, and the ASC, while it has a lower statutory rate, to the extent you have a spike in R&D spend compared to the prior years, more of that spend is going to be credit eligible, even though it's at a lower rate than it might be under the traditional credit. And so it really is an every year analysis.
Thanks, Marty. Next slide. Okay, so this is an important difference in the way we approach R&D. Today's presentation was really focused on boutique firms, but quite frankly, even in large regional and big four firms work that I've reviewed, this isn't always done as well as we do it to pat ourselves on the back. The focus here is to be able to track time by employee, by business component, by activity. And where companies, other firms sometimes fall short is they don't really break down projects into business components, and business component is the IRS term of art or vernacular that you really need to be able to do that analysis. And then they don't do the activity level of detail. And Marty had talked about the use of time tracking. And that gets back to my point about we really want to meet you the way you run your business. So we take your time tracking, we leverage it to the extent possible. What we often see is there are a handful of individuals, maybe senior people, who don't use time tracking, or the time tracking system doesn't have the functionality to track by activity. So what we do is we take everything that you create and the way you run your business, and we supplement it to the extent necessary in the way that we use time tracking. And this, as I think Carolyn mentioned, when you're filing amended returns, this level of detail is required. And so we've sort of just made it the standard in the way we approach our work.
And our standard process going forward is going to make it easier for clients as well. We're going to eliminate the need to utilize Excel. We're going to have an online tool that our clients can access along with us to have a pre-populated survey based on what they have, what they've done, and who works there, so they can allocate time on the web. And then it will automatically populate back into our database with the qualified research expenses. We're trying to make it as easy as possible going forward with our clients. Technology is clearly enabling us to do this better and more efficiently, which for you means lower fees, less time for us. And so it's really the intent there. But again, always with the human component of analyzing that and reviewing it with the expertise around what may be necessary for ultimate IRS review, and also making sure nothing gets missed so your credit's maximized.
Thank you, Marty. Next slide is a polling question. Does your company consider both methods, simplified and traditional, to determine the maximum R&D credit? First option, we do not claim the R&D credit or do not perform R&D. We only use the simplified method. We only use the traditional method. Yes, we're all over it. Or E, not sure.
Yeah, just for background, the R&D credit, as Vivian said, has been around since 1981. They came up with this alternative simplified credit in 2007 at a 12% rate, and later increased it to 14%. And it's almost become industry standard that everybody just takes the alternative simplified credit. But if you're in a startup position, there's actually a lower statutory rate for your first 3 years of claiming it. And so the general traditional method is almost always better for startup companies. And again, that's great for purposes of identifying credits that you can use against your payroll tax and shut off your payroll tax remittances for a period of time.
Yeah, and to Marty's point, there's a well-established, there's a Cohan rule that the use of estimates. So sometimes companies shy away from using the regular research credit, even though it might generate higher credit when they don't necessarily need to. So here's the results. again, that's great to hear. We want to follow up with you for those of you that don't take the credit. Thank you again for everyone for joining, and I'll turn it over to Ron to cover the next slide. Thank you.
Very good, Dan. Thank you. And thank you for attending today. I have a number of slides to go through, and I want to caveat them because we ultimately want to get to our panelist discussion of clients that we serve and just have a robust discussion in that area. However, we felt it was important, and hopefully you all have gathered that the research and development credit, even though it's been in the statute since 1981 and is permanent in the statute, is also a very complex area of the tax law. So we wanted to go through a number of what we refer to as kind of R&D credit hot topics that are out there today, just to make sure that you are aware of them. And I'll try and kind of highlight from a technical perspective a number of areas. So first of all, when you think about what has happened in disclosure requirements, this ultimately came through a chief counsel memorandum that was issued last year. And then the Internal Revenue Service on January 5th of 2022 issued a Q&A, or frequently asked questions. So the chief counsel memorandum I'm going to refer to as the R&D credit memo. So basically the R&D credit memo actually provoked concern among tax practitioners since its release. Both the American Bar Association as well as the AICPA submitted comment letters candidly in its opposition. Now, this is where we at Cherry Bekaert are, in fact, a differentiator, and we wrote a thought leadership position on this when the Chief Counsel Memorandum came out, and actually also did a podcast on this. We actually saw the Chief Counsel Memorandum positive in the additional disclosure requirements, i.e. the differentiation between using a CPA firm and a boutique firm, because a number of boutique firms came out strongly opposed. So what is in fact the R&D credit memo telling us? So basically imposed a set of new requirements for a valid administrative refund claim for the R&D credit filed on an amended return. In the context of the past, you could amend a return simply by submitting a completed and corrected Form 6765 or the form that we claim the R&D credit to. However, the R&D credit memo increases now in amended returns the amount of information that a taxpayer must provide with an amended return for it constitute a valid refund claim. And at a high level, there really are four key areas. First of all, there is going to be an attachment to an amended return that speaks to all the business components in connection with which the taxpayer is claiming the R&D credit. And specifically, the R&D credit memo wants to understand each business component and the research activities performed, all individuals who in fact performed that research activity, and then all the information each individual sought to discover. So you can see there is an additional, and some would say heavy burden. We do not see it that way. The other three things it requires that you attach to an amended return is what were our qualified employee wage expenses, the qualified supply expenses, and finally, what were the qualified contract research expenses. And as Carolyn highlighted, this did go into effect on January 10th of 2022. So any and all amended returns for those of you who have not claimed the R&D credit, but can claim the R&D credit, that is an additional disclosure requirement. Carolyn mentioned the election to offset employer payroll taxes. Candidly, we at Cherry Bekaert were very involved in this. This came through what is often referred to as the PATH Act, which ultimately brought in 2015 this ability with respect to, quote, qualified small businesses. And so ultimately, key things to think about the election. It must be made on Form 6765, as we've already discussed, and it has to be attached to the taxpayer's timely filed return for the tax year in which the election applies. So you cannot go backwards in time. That would be obviously a credit that would be only used on a go-forward basis on an income tax liability. So again, the election cannot be made on an amended return or a late return. And then when making the election, the taxpayer must specifically or specify the amount of the research credit, which Marty commented on. And then there's one other area that often gets confused is there is a requirement because you must file a timely filed return and you are allowed to begin to monetize the R&D credit on the subsequent quarter that you're filing a payroll tax return. And so you must submit what's referred to as an 8974, or in essence, a qualified small business payroll tax credit for increasing activity, which is communicating to your payroll provider that I am electing or I have elected on my timely filed return to use my R&D credit against the payroll tax monetization. And remember that that credit carries forward in the normal context. Carolyn already addressed the 250 went to 500,000 underneath the Inflation Reduction Act. And it also in that second 250,000 can be monetized against Medicare. So next topic, kind of hot topic, go back please, is in regards to opportunity to retroactively elect the alternative simplified credit method. Interestingly enough, even though these rules were really dating back to 2011, and then temporary regs were issued in 2014, and then final regulations were issued in 2015, basically in 2011, a taxpayer was not permitted to go backwards in time and elect the alternative simplified credit method. The temporary regulations that came out in 2014 began to allow us to do that, and those regulations were finalized in 2015. So you may go back in an open statute year and make an alternative simplified credit election. Often misunderstood, and there's also a lot more technical detail I could go through, but we just do not have the time. So the last, or not last, but the avoiding filing amended returns for prior open years. Carolyn mentioned this in the context of her comments, but this is what is often referred to as Revenue Ruling 8249. When you think about going back and not having to amend your returns because you've technically been in a net operating loss. And so it's important to note that Revenue Ruling 8249 was actually originally intended for the investment credit or the ITC. However, the IRS in a letter ruling in 2015-48006 stated that it is entirely reasonable to apply this ruling, though it was really for an investment tax credit, to the 3,800 or in fact the general business credit. And then they went on in the ruling to cite very specific statements. So if you are in a net operating loss position, note that you do not have to go back and amend your returns. You can utilize Revenue Ruling 8249 coupled with the IRS and the letter ruling to basically go back in time. And you can go back, remember, to the prior years and then bring those forward on a timely filed return and then carry that forward credit. So you can avoid filing amended returns for prior open years in which you could not utilize the credit or in fact when you're in net operating loss position. However, we did want to make sure that we stress that even though you do that to use the ASC method, you must go back to the under 6511, the open statute year, and actually file so that you are perfecting your alternative simplified credit claim, and therefore you can carry it forward. Any of those years before that are going to be underneath the regular method. So when we think about 280 Cap C, we're hoping all our listeners know what that provision is. But in essence, it is a necessity to make an election for utilizing the reduced research credit on a timely filed return. Even in those years, as we stated here, when a client cannot utilize the credit. Very important to understand that 280C election must be made. And so finally, the last topic, which is really confusing from a hot topic perspective, is of course, significant opportunities came underneath the CARES provision. And of course, we as a team do employee retention credit, but there is an interaction of the employee retention credit with the research credit. Three key takeaways here that I want to mention to you. First of all, the employee retention credit expired in the fourth quarter of 2021. But employers have 2 or more years to file amended returns. In fact, underneath 2 notices that came out, you can go back to April of 2024 to file the 2020 amended returns, and you have until April of 2025 to file the 2021 returns. So this is where it gets interesting, where you see ERC plus R&D actually equals some confusion. Buried within the two notices that I mentioned, 2021-23 and 2021-49, there was language about the interplay between ERC and the widely used research and development R&D tax credit. So it's very important to understand that you can claim the ERC and the R&D credit in the same quarter being used for the ERC purposes, but you must understand the timing and the ordering of those rules. And many businesses and many practitioners to this date, not us, are confused by those when the ERC and the R&D, and there's actually two rule changes in there which caused the confusion right in the middle of 2021. So pay attention to that from that standpoint.
Actually, we only have 10 minutes left, so we should probably get to our client panel.
I think we should get to our client panel.
Absolutely. I want them to still be our clients, so I didn't want to bring them over to this thing.
No, I appreciate the
Absolutely. So I want to thank very much Sue Crawford and Ivy Tomasco, who are working with us from American Forest Management, and Kendra Scott, respectively, for taking a little bit of time just to give their insights into some of the work they've done previously with, we'll call it boutique providers, consultancies, as opposed to a full-time CPA firm. And so, and also maybe some of the differences as they work with us or are going forward. So Ron, feel free to jump in and lead some of these questions around here, but because I work closely with Ivy, maybe if you want to start a little bit and just give some of your perspectives on your prior experience versus current and what you're looking for when you're trying to sign somebody up to help you with R&D.
Yeah, sure. Happy to be here. I'm the tax manager at Kendra Scott. For those of you that don't know, Kendra Scott is a women's accessory and jewelry company based out of Austin, Texas. Since 2005, we have grown to 120 retail stores, and we don't only just do selling of the jewelry, we actually create some of the stones that we put inside the jewelry. So there is a lot of R&D elements in our company, as well as a lot of internally based developed software. So prior experience, whenever I used a boutique term, I actually inherited the provider that we used. So I wasn't involved in picking that particular firm. But whenever I started on the project, we were associated with a team that was very technical, but not very relatable. And when I say that, it means we're a very creative company. We're dealing with all different types of backgrounds. And once you're dealing with this R&D tax study, and me as the tax manager trying to convince all of our employees to take time out of their day to come through it, most of the time when they hear tax, they want to run. So the previous experience that I had with them, integrating with our team employees, it was very hard to bridge the gap because you're dealing with creative people and very tax technical people, and they weren't speaking English to one another. So me as the tax manager, I kind of had to be the intermediary between both of the partners to kind of translate what each team was needing. And it was kind of a difficult process trying to manage that, as well as my other duties that I had. The other thing is whenever they were interviewing stuff, they were kind of not explaining what they needed, and it came back with a lot of additional requests that needed to come up after the fact. And it was already hard to get employees to sit down for an hour to explain all the information that they had. So having to constantly come back to them was a little bit difficult. The other thing I want to reiterate was I think Marty or someone mentioned about Irs Audit Documentation. So our previous company, previous firm that we used, we did go through a Texas franchise audit. And what I've noticed is while they gathered what seemed sufficient documentation, they have also come back to us asking us to provide more and more documentation. So while they did provide audit defense as part of their services, it was more additional work rather than them taking all the information and being self-sufficient whenever it came time for an audit. So it's just more work on that end. Being on the flip side of it, since I've gotten involved with Cherry Bekaert, I will say that the team is more well-rounded. Whenever I come to an interview conversation with any of the employees and their team, it's been very translatable, and they truly understand our business. The people that are interviewing our employees can range from talking about the specifics of jewelry composition and dealing with all of our designers and how they use their techniques versus talking to one of our software engineers in our IT department, and being able to have a team that can flip back and forth and not talking so tax technical very much eases the conversations and allows me to be free to have the consultants do what we're paying them to do. The other thing that I've really enjoyed is strategizing with our accounting firm partners. I will say with a specialty boutique firm, I found that they are very technical in one aspect, and they aren't looking or are not able to kind of look at the full picture of what is impacting you. I've partnered with our firm with Cherry on different issues, especially with the new Section 174.
Uh-oh, we got frozen there. That's okay. While Ivy's frozen, Sue, what's been some of your experience previously? You got frozen there for a minute, Ivy. Sorry about that.
Oh, I'm sorry. But all I would say is, like, y'all, whatever firm anyone would want to choose, I would say having somebody that isn't very pigeonholed in a tax technical topic, while that's great for the one thing, you do need to look out for a firm that is looking at on all different types of aspects, because you're not only focused on this R&D tax credit, you have other components that are hitting you all at once. And it is great to have a team that is looking at all different sides and looking at what actually at the end of the day is working best for you and what will be defensible for you in the end. So
I think the dramatic pause made that even better. So that was great. Sue, what was your experience prior to coming over? I know we're going to start working together, but like how are we doing? What was your experience?
Good. No, we're good. Yeah, American Forest Management, people don't really think as forestry is very technological, but it actually behind the scenes has a lot of technology and a lot of technology development. We always kind of felt that there was something there we could do with the tax credits, but we just didn't really have the manpower, the in-house expertise or to pursue that. But in the last few years with, I'm sure, and you've heard in the marketplace talk about LiDAR and remote sensing, all the carbon credit stuff that's coming forward. And we have a really strong technology team that's involved in a lot of studies and developing the ways to measure that out of, on a plot of land. And it just became more and more a larger part of our business. And it came time to start looking at, where we could get these credits from. We were using an outside firm that was referred to us, not a CPA firm. Even our tax firm that we're using at the time really just didn't have the in-house time to commit to the credits. But we just felt it was going to be something very beneficial for us to look into. Those first couple of years, the first year, obviously, more manpower on my end, getting the data, getting with our tech people to dump the data and provide all the information, getting people on board. As Ivy said, when they're talking to foresters, they don't always want to spend their time talking to tax people. Luckily, a lot of our tech people are the ones that they ended up talking with. That was where most of our, our low-hanging fruit came from, was a lot of these technology study projects that we do and work with the clients to develop new ways to use LiDAR and inventory jobs and measure carbon. And so they're a pretty technical group as it was. So they were a lot easier to convince to come on board and spend the time doing that. The biggest thing is we weren't really involved in a lot in the process. After the interviews and talking to my managers and the people involved in those projects, we weren't really involved in the calculation. We really didn't get a lot of insight on how they were coming up with the credit. We'd get a nice report at the end. Still just kind of leaves you uneasy. They would meet with our tax accountant. We'd have a big meeting before we filed our tax return and make sure everybody was on board, that the tax group was okay signing off on the credits that they had come up with. But there's always kind of this lingering question.
Yeah.
We were not involved with Cherry Bekaert at the time, but we have been now for the last couple of years. So we just see that it was time to move over to a group that, now that we've been doing audit work with them, they understand our business better. And I think that's just a key component. Everybody keeps saying there's more out there than just low-hanging fruit. And we're not seeming to get to it in the last 3 years of the studies. So we feel like working with a group that knows our business better, kind of understands the ins and outs, is going to be able to find some other things, and also maybe teach us better ways. We do have a project-based software. We set up things like a UDF that flags certain projects that we're pretty sure are going to qualify. So it makes going through the data each year a little easier. But we know there's still things that we're missing because we just don't understand it fully. And so we're kind of looking to Cherry Bekaert to give us some of that guidance and expertise, and each year maybe progress a little bit further down the road and get our technical group and our field people on board with better ways to track it.
And we're gonna, and we look forward to doing
Yeah.
that. I mean, my job is cool because I've been doing this for over 20 years, and I get to see what every company does in terms of what they consider most innovative. It's a really cool way to get to know different companies, what they're doing, and it just helps me relate better to the next one. And so that's what the whole team really is focused on. So I think we're out of time, and I'm sorry about that. So thank you guys so much. Oh, last polling question. Everybody get your CPE. So here we go. Do you believe your company receives the analysis and support your R&D tax credit claim requires? We do not claim R&D credits. That's somewhere between 9 and 37%. We'll see. Yes, we're all good. No, we could use some help, and not sure. I'll answer that.
No.
And we'll see what the results come back. To anybody on, I'm sorry we went a little bit late, but hopefully it was really good for you. I think this is my fault. The most interesting stuff was the client panel at the end, as always better than listening to me talk. And so I'm just very thankful to Ivy and Sue for coming in. So here we go. 24% no R&D. Please call us. Yes, we are good. 34%. No, we could use some help. 11% and not sure at 31%. Again, anybody who's not sure, we're more than happy to continue the education session and work with you. So with that said, we are now concluded with our webinar today. And I just want to thank everybody for attending, but most importantly to my team for helping me put this together, for their expertise, for their partnership, for collegiality, and Ivy and Sue for being trusted clients and working with us. Can't thank you guys enough.
Yep. Thank you for the opportunity.
You're welcome.
Thanks, everybody.